Resource markets. In this presentation, we will be talking about the market for the inputs of production that firms use to produce final goods and services. And in particular, we will focus on labor. All right, so now we're getting to an important question. How much resources does the business need or should buy? How many workers do they need to hire so that they can still maximize their profit? A quick note here, we are assuming that the market for resources, so the market for labor, as well as the market for the product itself, in this case we're going to talk about apples, assume that these two markets are competitive. No single seller or buyer in the labor market or in the product market has influence on the price of apples or price of labor. We're also assuming that every business is a profit-making business and their only interest is to maximize their profit. All right, so our analysis here is going to resemble the one we did for profit maximizing when it came to the product market. If you remember, we had marginal cost equal marginal revenue as our profit maximizing rule. So let's see how this applies to the labor market. Here's a number example. So this company here sells a product and they can sell their product at $10 on the market. This is their production function, so production pattern. You can see here the number of employees they would have, so the quantity of labor they would hire, and how much output that would allow them to produce. And our marginal product of labor would be what each additional worker adds to the production, right? So for instance, with one worker, you're able to produce 100 units. With two workers, you're able to produce 180 units. So the second worker allowed you to add 80 units because you went from 100 to 180, therefore you added 80 units by adding that second worker over here. We know from previous chapters that the marginal product of labor is diminishing, and you can see that happening right here. Now let's move on to this one, the marginal revenue product of labor. So this is how much revenue each additional worker will be able to generate for the business. So if, for instance, this first worker is able to produce 100 units, and you can sell each of these units at $10 a piece, then this worker generates $1,000 worth of revenue for you. Okay? And same thing for the second one. If the second worker allows you to add 80 units to your production, his contribution to the revenue is $800. Now let's compare this to how much these workers cost. So this, in a way, is the marginal revenue of these workers, and this will be the marginal cost. So each additional worker cost $500 a week. So if you look at this, how many workers should this company hire? Well, you can see that 3 workers is going to be the best option for this company. And the reason is that for the first 3 workers, the additional revenue generated per worker is greater than the cost of these workers. So because of that, the profits are always positive per worker that are added. However, when you get to the 4th one, you're only able to generate $400 of revenue with the 4th worker, but that worker is costing you $500. So this 4th worker would not be beneficial for you because you would start to lose on your profit. And therefore, the optimum number is only 3. As long as the marginal revenue product for each worker or each additional worker is equal, or it has to be less. I mean more, more, greater than the marginal cost of labor, which is the wage that is being paid to that worker. A few formulas to refresh your memory on these. Marginal product is always the change. So here, change in output, change in production divided by change in the quantity of resource. So change in output divided by the change in the number of workers in this case. Marginal revenue product of labor is the marginal product of labor times the price of the product, how much it could be sold for on the market. The marginal revenue product is also the change in total revenue divided by the change in the number of workers hired. Here's the rule. The optimum quantity of resources for the business is where marginal cost of the resource, so your wage rate, is equal to the marginal revenue generated by the additional resources. So the marginal revenue product of labor. So marginal revenue cost, marginal resource cost equals marginal revenue product of labor. This is consistent with our law of diminishing return. So adding a variable factor such as labor allows you to increase the production, but the additional production, the marginal product, is decreasing, meaning you get an additional production that is lower and lower with each worker added. And this is, of course, in the short run with fixed resources, meaning you are not, you're just adding the labor, which is variable. You're not changing your fixed variables, such as your capital. Here is a graphical representation of our labor market. So here is the demand for workers, and here's the wage rate. And so that would be our marginal resource cost, and here is our marginal product. And you can see that as long as the marginal revenue product here is above the marginal revenue cost, then these workers will be added. So 1, 2, and 3 will be hired because they add to the total revenue. They generate additional profit for the business. However, when you pass this particular intersection and now the wage rate is higher than the additional revenue procured by that worker, then that worker will not be hired. So 3 would be the profit maximizing number. You can also observe here that the marginal revenue product curve is also the demand for labor. So the two are one and the same. The following items can influence the demand for labor. So since the demand for labor is derived, if there's a change in the demand for the product that these resources help produce, then obviously the demand for that resource will increase. Change in productivity also. If each worker is able to produce more per day of work, then they will be fewer workers that are needed. The price of other resources. So for instance, if capital becomes cheaper relative to labor, then companies will hire more capital and less labor. And other various employment trends. All right, so this concludes this presentation. And just one thing to remember, to maximize profit, companies need to find that optimum quantity of resource they need to hire. And the way to do this is to have marginal resource cost, which is the wage that is paid to that worker, be equal to the marginal revenue product. Or if they're not exactly equal, you always want the marginal revenue product to be greater or equal to the wage that you have to pay for that work.